Okay. Hi, Roger. How are you?
Well, thanks, Simon. How are you?
Uh, yeah, great. So good to catch up again. This is the next series in our expert investor interview series with Roger Kinsky, who's a very well-known author. Also runs his own money in his self-managed super fund. Plenty of information on your website, Roger, which we'll get to in due course. So continuing on from our chat last time about investing and all things investing and psychology related, I guess, to do with it. Could you share a personal story of an investment decision that you've made that turned out to be particularly successful, or conversely the opposite, I guess, a learning experience? Tell us about that.
Well, when I started investing, that was 25 years ago when I sort of started seriously starting investing, because I was getting around about the time where I was getting towards retirement. Um, I bought some bank shares, and they happened to be Bank of Melbourne shares. And I thought, oh, well, they're pretty safe sort of investment, and but I thought they'd be pretty boring. Anyway, they turned out to be not anything but boring. They turned out to be very good because the share price kept going up, and eventually they got taken over. I can't remember now who took them over. I've got a suspicion it was the Commonwealth Bank. But anyway, they got taken over, and I made a darn good profit on those bank shares. And I suddenly thought, "Now wait a minute, bank shares aren't as boring as I thought they would be." And I so for my core investment portfolio, I bought all bank shares. So I got all the major banks and a few of the minor ones as well. And I bought the whole bloody lot. And you might say my portfolio was heavily skewed towards bank shares. But as it turned out, the bank shares have done particularly well over the last 20 years or something. From Commonwealth Bank, for example, I think they floated originally around about $5 or something. I didn't buy the float, but they got taken. One of the other companies I had, one of the other banks I had, got taken over by the Commonwealth Bank, so I automatically acquired shares of the Commonwealth Bank. And I joined the dividend reinvestment plan, so I kept getting more and more of them. And then I think they had a few offers, a few share offers, to buy more shares.
Yeah,
Uh,
share
and
plans.
I partook in all the share investment offers they had. I got bought the maximum number of shares I could. And so gradually they kept going up, and then they got to about $80. And, I thought, well, they might even get to 100.
Wow.
Next thing I hit 100, and then I thought, oh, well, they're probably not going to go any higher. And I get share tips. I get some share tips every week that one of the online organisations, gives out share tips, and I get them every week. And I give 18 share tips to buy, hold, and sell. And lately, over the last probably 2 years, almost every edition they've said, sell Commonwealth Bank, they're overpriced. Sell Commonwealth Bank, they're overpriced. And as I said, I don't always follow expert advice, so I didn't follow them. And every time they said sell them, they went up small. So now the Commonwealth Bank ended up at about $160. Now, by all reasonable analysis, they're overpriced, but they still
Right.
seem to keep going up in value. So until
Oh
they
God.
start to drop down in value, I'll still hang on to them. So
Yeah.
yeah,
It's
so
a
I found that was one of my great success stories. I found that banking shares were very good for me. They were a darn good investment. I'm very glad that I got heavily into bank shares in the
brilliant.
first place. So that was
Brilliant.
a good success story. Um,
Right.
I, I unfortunately, I had a few not so happy stories um, where I had owned companies that I held on to for years. I thought this is a good company, they've got a good product, they should make good money. And I held on to them. And I was a loyal investor. I held on them for years, sometimes years and years, and the shares did nothing. And eventually, this is where emotions come in, I say they shouldn't. You get sort of stick off and you say, oh, God, I've had these shares for so long and they've done nothing. I better get rid of them. You know, one of the companies I held was a little company called Pro Medicus, who I thought had an excellent product,
Yeah.
PME anyway. Bugger me, after I sold them, about a year later, they started going up and they just kept going up and going up and going up. And I'm tearing my hair off. I'm God, I'm sure I kept those Pro Medicus. Yeah. And the same with Sigma. Sigma pharmaceuticals. Around 60 cents, and they just stayed at 60 cents and nothing happened, and I kept, no one was interested in them much, and they had nothing on the horizon, and I just kept hanging on, and eventually I got sick of them and sold them, and then guess what, they got an offer to join up and amalgamate with one of the other big companies. The share price just skyrocketed since, and so it's very, they're the sort of things that it's really hard to predict. I knew they
Yeah.
were good companies. I knew they had a good product, and but you just get sick of holding them for so long. They took so long to get going, to
I
fulfill that.
guess
But,
the, and the best way to mitigate that, I guess, is would it be diversification, not having too many eggs in one basket, or because it's impossible, isn't it, to get every single call right?
well,
So
I think what I should have done, what I didn't do, what I should have done is I should have said, all right, after I tend to sell shares and then forget about them. So, right, I've sold those shares, now I'm going. And what you should do, I think, is sell the shares. And if you thought they were a good share in the first place, you should keep your eye on them. If they start to go up again,
yeah,
you buy back in. But see, that against that is a human psychology. You say, well, I sold these shares for, say, 60 cents. Now they're 80 cents. So to get the same, I've got to invest a lot more now to get the same value I had before. And psychologically, you're adverse to doing that. So this is where emotions come with it.
a good idea.
But
So
yeah, yeah. Well, I know my portfolio now pretty well goes according to the XAO, the All Ordinaries Index.
okay,
Generally, if the Ordinaries Index goes up 1%, my share investments are down 1%.
yeah. Well, that gives you
I've
peace
got a
of mind.
tracking of all different sorts of companies, big companies and
Yeah,
quite a few small companies, and and sometimes I beat the market, sometimes I don't. But by and large, I follow the market, and I think that's probably all you can expect to do in the long term.
yes,
I think people
yeah,
who consistently expect to beat the market, I don't know how they're going to do it. You can be lucky for 1 or 2 years, but to do that consistently over a large number of years,
yeah.
very. So
And
I'm
so,
happy with that because I think, well, the All Ords Index has had a history of going up, 6%
10%.
or something on the average over the last 20 or 30
Yeah,
years.
yeah,
So if I get that 6%, that's in capital gain, and then
yes,
I get a divvy on top of that, which is a frank divvy. So I end up with about another 3 or 4%. I'm making about 10% of the money, which is about what I've been doing. So and if you, as I said, if you can make 10% consistently over a number of years, your wealth does increase substantially over a period of time.
yeah. Well, that's right. Be every 7 years. I think the maths is, isn't it? If it's a 10% return each year, including dividends, and let's say you were reinvesting, which I know you like to do with the DRPs, every 7 years you're doubling your money. So
Well,
it's pretty nice maths, isn't it, when it works like
yeah,
that?
well, it's good maths.
Yes, indeed.
It's good
Um,
maths,
we like the math.
and the
We like the math.
nice thing about it is, I dabbled in real estate when I was living in Sydney. I had a few investment properties and what have you. Frankly, I found they were a hassle.
Yeah,
Like they were a hassle. You got to constantly, your tenants move out, and you got to get the place cleaned, and you got to re-advertise, and you've got to, you have problems with plumbing, and then you got to get that fixed, and then something else is going wrong with the place needs painting, and it's a
yeah,
constant hassle with shares. They're not a hassle, once you've got them, you don't have to sort of worry about going out and inspecting a property or who the agent you got to look to rent this property out, or
connections. Yeah,
am I
yeah,
going to be, Yeah,
I think,
so
look, you're right.
it's and as you get to retired, I think in my situation, I'm retired. I've been retired for a number of years. I'm looking for hassle-free investment. I don't
Yes.
need the hassle.
Yeah.
It's not worth it to me. Like I'd rather lose money and be free of hassles than make money and have a whole heap of hassles associated with it.
No, I think
When
that's
you're younger, you have a different outlook. You don't mind the hassle, but when you're older, you don't want to get
yeah. And
involved.
I've heard those stories before with retirees in particular, where part of their retirement plan, that their financial plan that is dependent upon rental income, and then they lose a tenant, and it upsets the apple cart. It's, as you say, it's stressful. You've got to find another tenant. That was part of the income that they planned to spend. I mean, dividends can get cut as well, but I guess that it's not the same magnitude in most examples as if you've got a well-diversified portfolio. I think even in the global financial crisis, the dividends dropped by about 25%, but obviously they've recovered since. And that's an extreme example. So I think, that's probably a good segue to the next question in terms of for people who are interested in shares as opposed to property, or they're doing both. With the online investing, the online share investing landscape, how much has it changed since, or how has it changed since you started in the game, and do you see any sort of trends emerging in the next few years?
Well, there's been a big increase in competition, which has led to lower prices.
Mm.
So, the brokerage is much less than it used to be in the old days, and you can you can buy for $10,000 worth of shares. You only pay $20 brokerage. Well, that's only 0.2%. It's extremely reasonable brokerage, and which means that you can buy and sell more readily than you used to in the old days, because you don't have to worry so much about the brokerage. When I was first year investing, I think the standard brokerage was about $50,
Yeah.
just for a buy or sell, as
Did you say
opposed to
300? Did you say
now I
300?
can get it done. Yeah, now
Wow.
I can get it done for say $20.
Yeah.
So it's a lot cheaper. Uh, and the second thing is there's a lot more competition, so there's a lot more places you can seek to do your online investing. You're not stuck to just one person. Used to be just the banks, but now there are
Yes.
a whole heap of different places you can do your
Providers.
online investing.
Yeah. Yeah.
And another thing that's changed is the settlement time. They're much shorter now than it used to be. In the old days, settlement used to be, I think it was 5 days originally, but now it's cut down to 2 days.
Yes.
And they're talking about having instantaneous settlement.
Same
It's one of
day.
the things that I'm working towards, which will mean you buy your shares and they're straight away. You don't have to have this delay of transferring the shares later on. And
Yes.
that's been another big change.
Right.
And I think another big change, a really big change that's come on the online investing scene, is there's so much more information available, and information is in many cases free. You can get a hell of a lot of information for free. For example, I've got a good technical analysis site that I go to.
Yes.
Gives me all the charting, all the indicators, all the one gives me, it does it straight away without delay. You can go back time periods as long as you want,
Brilliant.
and a whole heap of things, and doesn't cost a brass razoo. It's free.
That's, yeah, amazing, isn't it?
And another site I've got for a self-managed super fund, they deal with a broker, an online broker, and I went to their website the other day checking my shares, and they have search functions in there which are just amazing. You can say, right, I want a share that's got a PE of no more than say 20, pays a dividend of at least say 3% or 4%, and has a uh, whatever other criteria you want to put in.
Return
And
on
then the company
equity.
straight away, you get a list of 20 shares. from the
Amazing.
Australian market straight away. Comes up with
Yes.
us almost instantaneously. That's just
Yeah.
amazing, you know. So, so what it amounts to is that an online investor can now get the information they want without having to rely on someone else. Like in the old days, we used to have to rely on the broker. If you ring a broker up and say, you know, I'm thinking of buying such and such a share, and you go back and you have some special program you can look at and tell you how the shares have gone. Well, now you can do it yourself, and as I said, it's free. Or if you join a site like Comsec, you can you only have to trade once. You only have to, well, don't even that, but now you have to trade. You just got to set yourself up as a customer in that site and get
Yes.
a password and an account number and a password, and you can go to the site each time and you can use all the tools that they've got available there, and there's each of them. You know, so there's been a huge change in the amount of information available. And on the charting site I use, as I said, it's perfectly free. And that has got, I think, something like 60 or 70 indicators you can follow on your
Mm.
charts. And there
Can I
again,
ask, Roger,
I mean,
which
that's just absolutely amazing.
yeah, do you want to recommend that, or do you want to mention it to our viewers and listeners, the one that you use if it's
Well, the
free?
site like it I use now is big charts.
Big charts. Okay.
Yeah.
Yeah.
I used to use another site, but they started charging, and I thought, oh well, why
Yes.
should I pay if I can get it for nothing? So I went to
Of
big
course.
charts, and
Yeah.
you know, I found it's amazing. I can get just you don't, as I said, have to pay anything. Once you
But
just I've got it on my desktop actually on the tool taskbar, and I just click on that, and up it comes, and straight away it remembers you. It remembers you can put in the features you want, and it'll remember them.
yeah.
So I put all the indicators that I want at the
Yeah.
chart, and it remembers them. So next time I go in, it automatically comes up and shows me all those indicators,
So,
keeps me up to date. So
yes.
it's wonderful.
Yeah,
So
I think
that's been a huge change in the share investing scene. And
brilliant.
online investing, there's just so much information available there.
Yeah, I think, and your point about customizing screens and searches and filtering things out that you're trying to find as an investor in terms of some of those characteristics and qualities, be it fundamental or technical, the technology and the power that's out there now and available to the everyday investor, as opposed to, like you said, a long time ago, it was um, the control by the brokers or the investment banks, etc. Now anybody, for the most part, can get the same info,
That's right.
which is
That's right.
brilliant. And I know a lot of the services we cover on the investment newsletter group, they have that ability where you can screen out and you can build your own custom search tools and things like that. So it is truly amazing the power we have at our fingertips, whether it
Yes,
makes it,
I think it's amazing. It's
yeah,
absolutely amazing. You know that
I agree.
what's available now. It's
I agree. Yeah.
and I
Um,
think that the thing is that not that the information is available there, but a lot of people don't want to be bothered. You know,
of
they
course.
tell someone else to do it for me. They don't bother about it. They don't bother about it. You know.
Yeah, and it's buyer beware, and it's individual motivation, etc. You talked a little bit then about charting and technical analysis, and I know one of your books is called Charting Made Simple. So how do you sort of balance those two out with your investing? Can you tell our viewers a little bit about that, the technical versus?
Well, before I buy, when I'm once I've bought a share and I've got it in my portfolio, I keep track of it regularly. Now, because I'm not a speculative investor, I don't check it every day or every second day. I check it generally once a week on the weekend when I've got a bit of time. I go right through my share portfolio and I check it. Um, Now, I've got key factors that I've put in to my share portfolio that I automatically update every time I go in and update my portfolio. For example, I automatically calculate the PE and the dividend yield and so forth, and it goes up, you know. Now, fundamental analysis, if you don't have a share portfolio, I use fundamental analysis, or if you don't have a share in your portfolio, I use fundamental analysis to decide whether or not I'm going to buy that share. Now, in other words, I don't buy a pig in a poke. I don't buy a dark horse. I buy something and again, the information is so far available. Now you'll find a lot of investment advisors or investment advice you get. They'll put a little disclaimer on it and they'll say, "Oh well, past performance is no guarantee of future success," which is true. But at the same time, if you look at, say, a sporting event like tennis, all the top tennis players are all graded. They're all seeded, right up to about 200 and something. Now, if you had a tennis match between someone graded, say, a seeded 5 against someone seeded 20, then you pretty well be sure that the person who seeded 5 is going to win that. We're going to win it. Now, there's no upsets, but upsets do happen. But by and large, that you can tell what's going to happen from the seedings. Now, the same with in the stock market. You can look at it as though all the stocks on the stock market are seeded in a way that they've all got a track record, and you can go back and check that track record. Now, that track record may not repeat in the future. It's the best guide you've got. And so if you get a company that's consistently made profits over the last 5 years, the chances are they're going to make profit again next year, right? And so that I use fundamental analysis for that basic, basic share analysis. I won't invest in a share unless I check unless of course it's a speculative share. If it's a speculative share, it doesn't matter. They're not done anyway. So forget about fundamental analysis.
Doing the work, yeah.
Then I use technical analysis to keep a track of the share. As I say, every week when I check my share portfolio, also go into big charts, I have that on my screen. As I check the share price and everything else, I check the graph as well. And I look for any sort of unexplained jumps or drops in the share price. And if there's been a sudden change, I'll then go like, I'm with Comsec, doing my training with Comsec. So I go to the Comsec site and I look at an announcement. And I see if I can find some reason for it. In other words, why did that share suddenly drop in price, or why did it suddenly go up in price? And I'll try and find some rationale and some reason for it.
Yes.
But the technical analysis enables me to keep track of my shares. And then I use technical analysis. I haven't bought the share yet. I'm thinking of buying it. I use technical analysis to hone my investment decision, my timing. So and my golden rule is I don't buy when the price is going down, and I don't sell when the price is going up. Now, with all the complications of technical analysis, they're two pretty simple rules. You don't buy when the price is down. Well, I don't mean but day to day. You can get day to day fluctuations of a few cents all the time. It makes sense. But like, when I check my weight every week, okay, I vary. Sometimes I vary up and down, probably a kilo. They're insignificant variations. They're just, you can't explain it. They're just due to, day-to-day fluctuations. And those could occur with shares. But if you're looking back over a longer trend, and you can see that, hey, over the last few weeks, this share's been going down all the time, I wouldn't buy it.
It's a warning signal.
Each time they tell you to sell, and you think, now's the time I've got to sell. And I look at the chart and I think, the share price is going up, and I've got to sell it. So my golden rule is I don't sell it if the price is going up, and I don't buy it if the price is going down. Now, those are two very simple rules that you can apply and keep yourself out of a lot of trouble.
Yeah, that makes sense, doesn't it?
For the day-to-day sort of keeping track of the shares and deciding if I'm going to buy a share in the first place or sell it when I look at technical analysis.
So I think, it makes sense. In a way, it's a little bit following the trend or the momentum, perhaps. I've heard that term used before. And, purely using the price, right, to refine your buying or selling decisions. And it sounds like a good investor can, like you do, blend them both together and get a satisfactory or better result. So that's really useful insight. And again, maybe direct people to your book as well. Charting Made Simple. Let me get the screen share up just so viewers can see. Is that showing the screen for you, Roger?
Yeah, that's showing Charting Made Simple.
Yeah.
That's showing shares, starting with shares, but starting with shares got a lot of that stuff in it as well.
Great, perfect. So, well, thanks. We'll wrap that up today, Roger. Thanks again for your time and wisdom as always. Looking forward to our next chat. So, catch up with you soon.
Okay, thanks, Simon.
Thank you.